Welcome back, everyone. This is our second edition of Fixed Income Forum. My name is Jay Bunkaria, a senior manager in the investment management segment at S&P Capital IQ. I'm here today with our special guest speaker, Terry Benzschawel, a managing director in the Global Credit Markets Department of Citigroup's institutional client business, to discuss the latest trends and insights into the fixed income markets. Terry is responsible for managing Citi's global credit inventory, along with developing tools and strategies for credit trading and risk management. Thanks again for joining us today, Terry.
Yeah, hi Jay, thanks. It's great to be here.
So the first thing I wanted to ask you about is liquidity in the marketplace. It's been a big concern as regulators and market participants are looking into the structural issues behind it. So what's your take on the current market's liquidity as well as it moving forward?
Well, it's interesting that you asked that because, in fact, that's one of the things that our clients are asking us about most. In general, our clients sort of say that liquidity is fine for small amounts, say $5 to $10 million worth of corporate bonds, but very poor for larger amounts. And in particular, during times of stress, when everybody's selling at the same time, basically prices gap very, very widely. So they're actually looking to us for solutions. And in fact, that's one of the things I'm working on right now. Really, in general, there's been no real general solution proposed, but the approach that we've taken is to try to replicate a client's portfolio with credit derivatives, that is credit default swaps, indexes, and the 0 to 3% tranche of single tranche CDOs. Thereby, what the idea is that we can replicate a client's cash portfolio with these assets so that they can keep 95% of their portfolio in cash and maybe 5% in these very liquid credit derivatives, such that when there's a sell-off, they can liquidate the credit derivatives instead of the assets that are declining rapidly in price.
Interesting. And how are they taking that?
They're very enthusiastic, actually, and in fact, there's a big effort, even combined with other groups in our firm, to put together that strategy with some ETFs that would also be more liquid than the individual credits and so forth. So we're exploring a number of solutions, and just sort of shows you that it's a very hot topic and getting a lot of attention by us.
Yeah, that's an interesting solution to that issue that's really been big in the marketplace. The next thing that we are hearing about, which is on everyone's mind, is interest rates. When and where and by how much is the Fed going to raise rates? So, with that perspective in mind, not only when this happens, how do you think it'll affect domestic, but as well as foreign markets as well?
Sure. I mean, in that regard, right? I have my sort of methods really reveal nothing that really runs counter to the consensus view. And the consensus view is that basically rates will rise, but that we don't expect any drastic rise in rates. Now, one reason, by the way, that we think that the first sort of rate increase won't really affect things much is that the market seems already to be adapting to the rate increase. Now, I brought a slide along that shows how Treasury rates have changed even between April and August of this year. And in fact, across the board of Treasury benchmarks, rates have risen by 30 basis points already in anticipation of Fed rate changes. Now, also, another reason that I think that the sell-off won't be too bad is that what's going to happen is that higher Treasury yields are going to attract investors who have abandoned Treasuries for the equity market, even cash, or short-dated, high-quality credit, corporate bonds, for example. They're going to come back to the Treasury market, thereby helping keep yields down. And finally, it should attract some foreign investors as well, who would find U.S. yields attractive, given that yields elsewhere are not that high either. And finally, it should be good for the dollar.
Interesting. So with the rise in interest rates, the next thing to be mindful of is credit risk as well. And our next chart that we'll show here shows some of our probability of default market signals that we track over here at S&P Cap IQ. And we can see that the investment grade sector has been pretty flat over the last 3 months in terms of credit risk rising, but we're noticing that high yield has gone up. Even when you exclude energy from that high yield mix, we've seen a sharper increase in credit risk in high yield over the last month or so. So I know at Citi you track various spread to PD metrics in the marketplace, and I just wanted your take on, do you think the market's cheap, fair, or rich at this time, and where do you see it going from here?
Okay, and it's sort of in the theme with my thoughts on the Treasury market. I think we see the same thing in the credit markets. Credit markets are beginning to adapt to the thought that the Fed might be raising rates. And as regards our indicators, actually, and as you say, we track, we find that the ratio of the current spread to the predicted one-year default rate is a pretty good indicator of where spreads will be next year. What we find is that actually spreads in both investment grade and high yield markets are actually trading a little bit cheap, meaning we might expect them even to tighten amidst things. Now, one caveat, of course, is that we're in a sort of a different environment, right? We've never experienced QE, and my back testing has been done on, in other kinds of periods. But in any case, again, basically, what we might expect, and one of the slides I brought speaks to that as well, is that when you look at the credit spread versus maturity curve, what you see is that very short-dated credits are very tight, but that longer-dated credits seem to be roughly at their long-term averages already. So what I might expect to see is, rather than a whole sell-off in the credit curve, I might see a rotation out of short-dated corporate bonds into longer-dated bonds.
Okay. And what about in terms of a sector basis? Where do you see really, value in terms of the overall sectors as well?
Yeah, and we do track sectors, and in fact, where we see actually sectors are very tight around fair value right now. And what we see is that the energy sector, despite the fact that people are shunning the energy sector, it appears actually to be the cheapest sector right now. Okay, somewhat indicative of being a little bit oversold. Whereas utilities and consumer sectors are the richest sectors right now.
Thanks again for your time today. Much appreciated, Terry.
Okay, my pleasure, Jay, and thanks for inviting me.
Yep. For those that would like to learn more about the latest trends in the fixed income markets, please go to our website below. Have a great day.